Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time.
All opinions expressed by the host and the podcast guests are solely their own opinions. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable.
This is a very special episode of Compounders, number 100. To celebrate that milestone, my guests on the show today are Alex Rubalcava and Connor Sundberg, managing partner and partner respectively at the early stage venture firm Amplify LA. Alex and I have been friends for many years, and it is an absolute treat to finally get him on the podcast. Alex recently merged his firm, Stage Venture Partners, into Amplify, where Connor was already a partner. In this intriguing conversation, we covered the rationale for the merger of the two investment firms, how they expect decision-making and sourcing to change going forward, the idea of focusing on companies that are tackling challenges that are different and hard, their current views on the pre-seed and broader venture capital investment universe, and how this apocalypse is and isn't impacting how they view investing in enterprise software companies. And without any further ado, here's my conversation with Alex and Connor from Amplify LA. Alex and Connor, great to see you. We're going to do something on this episode that we really never do. Traditionally, we dive right into the first question. But since this is the 100th episode, I wanted to commemorate this moment. And I can't think of a better guest than my good friend Alex, who's I finally convinced to come on the podcast. So Connor and Alex, first of all, in the totally uncompounders-like fashion, thank you for coming on to Compounders and representing the 100th episode.
Well, congratulations on getting to 100 episodes. You've had some great folks on the podcast in years past, and I am grateful that Connor and I can be your number 100. And here's to 100 more.
Yeah, let's get there. And so the reason you guys are on is a lot of the reason is because you've just completed a really interesting merger of your two firms. And I'm not as close to the venture investment community as you are, but I certainly don't see a lot of headlines regarding venture firms merging. So Alex, maybe you can take this. How rare would you say mergers like the one you guys completed are indeed?
I think they're more common than you might think. A lot of venture firms have been formed as a result of mergers. Going back almost 30 years, Benchmark was founded by a set of junior partners at other firms who decided to merge together and build the next generation of what they hoped would be a world-class venture firm, and they've obviously succeeded at that. Closer in time and closer to home here in Los Angeles, our friends at Bonfire Ventures started a decade ago after the two predecessor firms, Double M and Rincon Venture Partners, came together in a merger of equals. And so what Amplify and I have done with me merging into Amplify and retaining the Amplify brand name, but actually merging our firms and merging our LP base and our investor and our investment focus, it's more common than you would think, and it's a reasonable and good way for a venture fund to grow. From my perspective, when Connor and Paul approached me with the idea for the merger last fall, one of the ways that I thought about the option to join with them was that if I had done my job really well and set out to raise my fund for and built a team around me and brought in institutional capital and done all of those things, in 4 or 5 years, I would have a firm that looks like what Amplify looks like today. And instead, I get to immediately have that kind of a team around me, that kind of institutional backing, and that kind of a firm with more resources than what I had when I was a solo GP.
And a lot of our listeners either run or work for investment management firms, and they probably have heard about some nightmares and mergers in these situations. And they probably think a lot about culture and cultural fit. So either one of you can take this, but I'm just curious about what do you think the elements are that need to be in place beforehand for one of these mergers to work?
I think, we had gotten to know Alex for quite a while, which I think is one of the first things to get across, right? And so for us, this wasn't, an unknown quantity. We had gotten to see Alex work firsthand for over a decade in the LA ecosystem. And so Alex's career in venture goes all the way back to pretty much the founding of venture in LA. And funny enough, he actually helped underwrite at a prior firm one of the companies that one of our co-founders at Amplify had actually started back in the day, and co-founded as CTO. And so the history really goes back quite a ways. And I think that was, prerequisite number one that we were looking for. Like we wanted to have this, long kind of arc that we had gotten to see Alex's career firsthand. We had gotten to overlap on a couple companies where we had actually invested together. And I think you really get a sense when you, serve on boards or you advise companies firsthand of who the good operators in the room are. And so a lot of like what we were looking for is how is this person kind of, regarded by the companies that they've backed over time. And so that was one of the things. And then something that I think also doesn't get enough attention, but was important for us, was actually, it's funny, people say you must be very similar, right, to want to merge in the first place. But I think there's actually, an importance to the differences, right? And so when we were looking at what Alex was doing, if he was identical to us in terms of the exact investment amounts, the exact types of companies, like if we had had too much overlap, it actually wouldn't have been as interesting to us. And so one of the things that we were looking for was Alex had, specialties in different sectors that we had done less of at Amplify. He had found success in diverse areas that we hadn't done as much of previously. And so I think a lot of like what made this a compelling opportunity to us was actually finding that kind of value in the difference as well.
And Connor, you highlighted a number of sort of coincidental things like Alex being involved in that investment, but also like the personal knowledge that made it, an obvious candidate for a merger. I'm curious, as you guys were discussing this opportunity internally, what were the potential failure points that you identified and were intentionally trying to avoid in this situation?
Yeah, I'll let Alex kind of add on to this, right? But we're a team of 4 people over at Amplify, and so when you think about adding, one more person, right, that's a 25% increase in the team. And so when you're thinking about like the scale of a smaller team, right, that changes the dynamic quite a bit. And so I think one of the things we wanted to have a really good handle on going into it was just, can we work with him, right? Like we'd obviously worked together, but from an outside capacity. And this was, a different thing in terms of bringing someone onto the team and into all of our internal conversations. And so even before we, kind of officially announced the merger and had, agreed to it, right, we had invited Alex in to actually join calls with companies with us, right, to, participate in some of the diligence we were doing ahead of time because we wanted to see, what that process would look like, right? And then I think, Alex, you can share more on this, but you had been operating, solo for quite a while. And so I think for you, there's a big dynamic shift into all of a sudden being, on a larger team and having, more layers to the decision-making process.
Yeah, it's no secret that I've gone through the departure of a partner before. And so getting governance right, getting culture fit right, getting all of those things due diligence correctly when you're evaluating who to partner with is a really important part of the process of merging a firm like we have just accomplished. One of the things I told Paul and Connor last fall as we were going through this process is that like this is vastly more important than any individual investment we will ever make. It's probably more important than, the next 10 investments we're going to make put together. So we need to do a commensurate level of due diligence in order to all feel confident that we're going to go about this and that we're going to really be a good team going forward. So, my wife and I, went out to dinner with Connor and his now wife. We did the same with Paul and his wife, Odette and his wife. I spent time with Katie. Like, even though I have known all of these folks for a decade, I essentially was re-underwriting the friendship, re-underwriting the relationship, re-underwriting the quality of work that Amplify is known for. Because it's one thing to know that when we're occasional co-investors and friendly collaborators on a cap table, it's an entirely different level of confidence that you need to have when you are committing to raising capital together, to speaking for each other as part of the representation we have with portfolio companies, and then ultimately delivering returns to our investors. And we did 100 days of work once the offer had been made in the fall, before both sides felt like we were ready to say yes.
So it sounds like there was an existing relationship, there was a history, and there was a fair amount of diligence done, even,
Mhm.
kind of in towards the end of the process. So you had that as the backdrop. And now we got to look forward. So, in any merger like this, you're hoping that 1 + 1 = 3 or even 5. So what is the 1 + 1 is way greater than 2 logic tied to bringing these two firms together?
There's a few aspects to it. I think there's in the venture world, we have the startup side of our business and we have the investor side of our business. And there's a lot on both sides of the business. There are benefits to this merger. On the investor side of the business, both Amplify and Stage Venture Partners, prior to the merger, had over 100 LPs each. And when we were going through our diligence, we brought our investor list together and compared all of them. And I looked at all the names on the Amplify side, and I said, "Who are these people?" And then Amplify looked at all the names on my side and said, "Who are these people?" And the great news was that there was no overlap at all among our LP bases. And so we now have a much broader base of investors that have backed our firms in the past and that are active and engaged investors in our firm's history. And now, with our most recent LP close, we are starting to combine those two LP bases for the first time. So that's on one side of the business. Sticking actually on the LP side of the business for a moment, another thing that has a lot of value is the continuity, the continuity in the investment professionals in our team. And so Paul has historically taken the lead at Amplify when it came to LP fundraising. I've obviously taken the lead at Stage VP because there was no one else to do it. It was just me. And now, for the first time, both of us have the benefit of having partners who are LP closers and who are able to do that. And, I am exactly in between Paul and Connor in age. And so now we have a multi-decade setup where the firm has a level of continuity that is in place and ready to go for decades to come, that can reassure LPs that, like, this is a firm built to last here. And we have that in a really, really strong way now. And, even though I'm the new guy on the team, I've only been, a part of the team for 5 months. I've known this team and I've worked with this team, in one case with Oded, going back 25 years. So there's a lot of continuity there. And, the next newest person on the team, has been here for 9 years. So we are well in place for the long term. And then on the startup side of the business, where the merger has a lot of value, is that Amplify has historic success in healthcare, in logistics, in fintech, and in a couple of other verticals within enterprise software. I've got the background in manufacturing, aerospace and defense, robotics, and data as a service businesses. We are now in a position to do all of the above. And we have two companies with signed term sheets that we're going to be investing in the next few weeks. That will be the first from the combined platform. We have a third that I think hopefully we'll have a term sheet signed on shortly thereafter. And they are a great representation of the breadth of verticals at which our firm can now operate, and which neither of us would have been strong enough to do all of these kind of deals together.
Thanks for that, Alex. In Connor, as you think about adding another person to a small team and someone who's also very senior and made investment decisions, there could be some kind of, the division of labor becomes, I think, a little more challenging. So how are you thinking about dividing labor between sourcing and diligence, portfolio support, LP management? How do you make sure that everyone's got their right lanes that they can cross, of course, but that someone's got ownership of all of those things in a kind of sufficient capacity?
Yeah, it's a good question. I would say, for one thing, I think to succeed in this business over a longer time period, you kind of have to be someone who thrives in ambiguity. And then I also think, a function of working on a smaller team, right, is, everyone's used to doing a bit of everything. And so it truly is a team effort when we're looking at companies, when we're bringing in new business, when we're looking at something like fundraising. And so I think, one of the things that we talked a lot about before we brought Alex on was if we were looking to make an additional hire at Amplify, right? One of the things that we, thought about in advance was if we had hired someone maybe with more of an IR or a fundraising background, right? That might, benefit Paul on our team more than it would benefit the rest of our team. If we hired someone who is maybe an associate, right, or a senior associate level investment hire, that would help me with a lot of the first party diligence, right? And sourcing new companies, looking at new investment opportunities wouldn't add as much benefit to the other people on the team. And, for Katie, our director of operations and platform, if we had hired someone to help her, right, manage those networks, it, felt like it would benefit one person and not benefit, kind of the entire picture. And so Alex, having been a solo GP before, right, and run every aspect of that firm, it felt like a unique opportunity where we could bring someone into the fold who would kind of benefit every single bucket across the firm. And so that was something that, was really appealing for us, right? You always feel a bit short staffed. And I think, we will always probably have more than we can possibly take on as a team. And so having someone who can kind of participate across every level is a real game changer.
You really do have to do everything when you're an early stage venture firm. As part of my tryouts, they made me ride a unicycle and juggle and recite all the presidents in order.
Did you do it? I mean, that sounds pretty easy out there.
Well, maybe it only felt like that, but but that is, I think, a very good point. Is that we do have to do all of those things, and there are very obvious points at which the value of a combined firm become apparent. One of those is that both Amplify and Stage have historically been lead investors. We are not, as a firm, either in the past or today, the kind of venture firm that says, oh, call me back when you have a term sheet. We are the people who write term sheets. We are the investor of record. We are the investors that develop conviction and momentum for a founder in their first round. That always means, because we don't have the world's biggest balance sheets, we have to find co-investors to help our founders put a round together. I've been doing that for a decade plus at Stage VP, and honestly, going back 25 years through my career at prior venture firms. But there are only so many venture firms that I know, and there are only so many partners for any kind of deal that I would know. Now, when I want to lead a deal, or when Amplify wants to lead a deal, we have our combined networks to benefit from. And so on the two deals that we've already agreed to lead, we have made introductions for potential co-investors that vastly exceed what I could have done on my own at Stage VP, or what Amplify could have done before I brought my network into the fold. And we expect that to continue. And I think that's going to make us more likely to be a lead investor more of the time than we would have been otherwise. Again, our preference is always to be a lead investor, but sometimes, you get a call on a deal that already has a lead investor. But if I had my druthers, I would rather be the lead investor every time.
Sure. And I think if I'm put on my LP hat, where something like this doesn't work is if somehow the decision-making mechanism gets skewed in some way relative to what was done in the past. And so, Alex, I know as a solo GP, you were making those decisions on your own. Always hard to make decisions on your own under uncertainty without feedback mechanism. So I could really see the benefit of having people like Connor and Paul to bounce ideas off of. So maybe talk a little bit about how you have scripted and kind of figured out how to handle who's going to make the final decision question.
Yeah, I mean, there are obvious resources that make my process better from day one. Number one is the co-founder of Amplify, Oded Noy, is a CTO at Crexy, a real estate technology company here in LA. And he is our CTO and technology lead for when we're doing due diligence on a company. And there have been a number of cases since I've joined where I would have a founder, usually a CTO founder, give a presentation and have a meeting with Oded and surface issues in a 1-hour meeting with Oded that would have taken me 20 hours to surface on my own and arrive at a similar or inferior conclusion to what Oded was able to deliver in 1 hour. And, as somebody who thinks of myself as pretty good at evaluating technologists and companies with high technology risk, my resources have only been elevated as part of merging with Amplify. So there's a real obvious benefit there. There's also the benefit of having, more experience and more perspectives around the table when we're pursuing something. And so, we're asking, I think, better questions as a result of the team being together. We certainly have more surface area and breadth in our relationships and our networks for where we can turn for evaluation of companies. One thing Amplify has historically done as part of its due diligence that was not part of my playbook before joining the firm was to rely on existing Amplify founders pretty early in the process when evaluating a new company in an adjacent area of technology or industry. Connor, is very good at immediately saying, oh, this would be a great company for, the founder of Telgorithm to take a look at, or something like that. I have historically not immediately moved to that diligent step when evaluating a company in the way that Amplify has. And I realized it was a really good idea and something I should have thought of before, but Amplify does it, and now I do too.
And Connor, I think, I don't know how it worked before Alex joined, but you just added another senior investment professional to the process. So I'm just interested in your thoughts on, where the buck stops as it relates to decision making, and then also how you're thinking about resolving conflict when you're sitting in a meeting and you're really excited, and Alex is sitting there looking like he's about to pass out because he's so nervous about it. Like, how are you going to handle those situations?
I think the first thing to stress on my part is a lot of times that's actually a benefit to our process, right? And historically, we've had a very flat decision-making hierarchy, right? And so everyone's voice at the table is kind of, respected as equal weight in our investment decision-making process. And I think, the longevity that Alex brought up, like our team has been with us, for quite a long time. And that stems directly from that, right? And so we want more of that. And I think, we are excited as a team to have this sort of like intellectual spar, right? Where Alex brings a different set of companies' prior experiences, a different worldview to the table, and that makes our decision-making process better, in conjunction. Paul on our team always says this, right? He's like, over the arc of his career, now 20 plus years in venture, the best investment decisions that they've ever made have been the ones that have had the most kind of contention in the process, right? Sure. Because I think if everyone was either just, in agreement too easily, right? Or you kind of had this kind of groupthink phenomenon, chances are you aren't, kind of thinking about what you should be. You aren't taking the risk, that you need to be, right? And so I think a lot of times, like, we rely on that, right? Someone at, the table is going to have a stronger perspective on something, and the onus kind of flips to them, right? To bring everyone else, up to their view. And I think we've had a good example of that in even just the past couple weeks, right? Alex being really excited about a particular company and that really coming to bear, right? Like him kind of testing ideas, asking us, why is it that we're leaning out on certain aspects? What could, he be looking into? What could he, find to sort of, help us kind of formulate the thesis together as a team? And so I think you really just see the benefit of that process when you do have that debate internally, and we foster that. We want more of that.
And that's a good segue to a question I have about the investment philosophy and what you're focusing on. So I recently listened to an Invest Like the Best podcast with Gavin Baker from Atreides Management, where he was saying they look for companies that are doing something different and hard, right? And that, to me, that's where you get the contention. If everyone sees that there's an opportunity, then it's going to, it's hard to be successful. It's easy to get people excited about it, but it's harder to be successful. So as you think about the investments that you're really excited about, does it have to be different and hard, or can it also, go into a, kind of a Charlie Munger idea, like simple's better, right? Just find a really simple business like Costco that just does the same thing over and over. How do you bucket those things and think about them internally?
Usually, different and hard is a good thing in venture. And it's a good thing because technology risk is the kind of risk when you get over it, you have a, a, risk when you get over it, you have a, a risk when you get over it, you have a, a risk when you get over it, you have a, a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when you get over it, you have a risk when technology risk is the kind of risk when you get over it, you have a competitive edge in the market that in some cases can be long lasting. I think a good example of that in my portfolio from Stage VP is a company called Gray Matter Robotics. It was a seed round that I led back in 2021 for a company that develops robotic systems for industrial surface treatment. So think grinding, sanding, deburring, painting, sandblasting, etc. They work on everything from aircraft wings to big naval systems and boats to recreational vehicles to guitars and football helmets. And when I funded that company, I couldn't find another vendor on the entire planet that could get a robot to do that. That was 5 years ago. There are a couple of companies that claim to do what Gray Matter does in certain applications. I'm not aware of them having landed any material customers. And so Gray Matter is so different and so difficult to do what they do that after I've been invested in the company for 5 years, I can't really identify who the number two vendor is. I can't figure out who their major competitor is. The company, like all companies, has plenty of other risks that they have to continue to grow through as they have for the last 5 years. But competition is not much of a risk factor. I tend to really like investment opportunities like that. I like to take that kind of risk because you'll find out whether you're right pretty quickly, usually in the first year or two. And then when you're right, you own a market that is pretty consequential and you don't have to contend with 24 other vendors for customer budgets.
And either of you can take this one. I have the obligatory, like, what's going on in the market question, because I'm fascinated by it, but I think also people will love your perspectives. So I see so much activity in the venture community, and I see, Alex and I were talking about the $65 billion raised by Anthropic this week. And it's astonishing the amount of money that can be raised and the headline valuations that I see. So I'm just like, this is a moment in time question. I'm just curious as you guys see this, and my guess is not everyone's doing something different and hard, right? That just can't be the case. So I'm just curious, like, as you guys look at that and see all the activity going on, in a lot of cases around you and not where you guys are focused in the pre-seed market. But I'm just curious, like, what does this moment feel like for you guys?
Yeah. One thing, and it maybe relates a little bit to the prior question, right? So maybe it addresses a part of both, but there was a graphic that was shared a little bit ago. I'll try to find it and kind of send it to you after. But the point of it was basically showing kind of the dominant theme in every given vintage year in venture. And then it showed the top performing company of that vintage. So the company started in that year against the dominant theme in that year. And I think in every case that the graphic showed, they were different, right? So the company that achieved the highest valuation, the most success in the market, was counter to the dominant theme at the time, right? And so I think that's something that we think a lot about, right? And when you have a moment like this where it feels like everyone is kind of rushing in, everyone's eye is on the same ball, you feel that sort of sense of, kind of fear in the market, right? In the fast following, we really pay attention to that, right? Like, what are the things that we should be paying relatively more attention to that we're probably not thinking, enough about right now? And so that's one thing. And then I would say too, there's a very different structure to the current market, right? And I think a lot of that is kind of indicative not just of private markets where we are, but you see that in publics as well, right? And so the influx of capital that's gone into public markets, the democratization of retail investing over the past decade and a half, right? You have an unfathomably large amount of capital and attention going into public equities. And I think that's almost led to this flight where a lot of that capital that used to sit in publics is looking for diversified opportunity in private markets. And that kind of leads to, huge influx of capital at the late stage of private markets, right? And so you see, it used to be exceedingly rare to see a Series E round, right? Anything past a Series D. And now you see almost every letter of the alphabet, right, represented under the late stage private names. And so I think there's a lot of that taking place, and it sort of describes some of the activity that you're seeing, right? But it's fundamentally different than I think like the part of the market that we play in. And so at Amplify, right, and our team is focused on basically companies as close to inception as possible. I think that is the purest form of venture, right? Venture exists as an asset class to take the risk that no other part of the market is willing to take, right? And so you have to kind of be on the earliest part of that journey with these companies to sort of have, the long-term time horizon and get that differentiated value over time. And so I think the part of the market that we're in feels very different, right? It feels like we're not operating in, all of the craziness that you're describing, right, in late stage privates. And it still feels like kind of the essence of what venture is meant to be. But it does definitely affect like the way that we underwrite out the outcomes that are attainable by our companies, the amount of demand and, the different levers we have to achieve liquidity at the later stage. And so those are all things that, we're actively thinking about.
When you talk about venture capital, I think it's important, as Connor just mentioned, to distinguish between the very early stages of investing in a company and the later stages. And, the part of the market that we play in, we play a game of conviction. We play a game of believing in a founder, believing in a product, and believing in a new way of doing things almost always before it's obvious. And we pay for that belief with more risk than you take later on. And we have companies that don't make it because they try to build something that turns out to be too hard to build, or that can't get downstream funding, or that doesn't have customers who are willing to pay at a level that would make a business profitable on unit economics. And so in order to pay for all of that risk we take, we have to have commensurately higher return expectations on the investments we make. At the same time, the later stage venture folks are usually investing in companies where those kind of risks are in the past, and where there's a degree of obviousness may not be the right word, but momentum and king-making that has already happened. And they are playing a game not of conviction, but of access. And we often use interchangeable words: funding round, Series A, Series B, Series C, venture capital. But conviction investing and access investing are two very different things. And we see it all the time where we're trying to raise, a couple $1,000,000 for a portfolio company to finish out a round that we're doing. And then at the same time, we're getting, urgent emails from, LPs and wealth managers and folks we know saying, we would like to buy $250 million worth of Anthropic shares by Thursday. Do you have any that you could sell us? And, it's a totally different world.
Yeah, I certainly feel that. And as you guys you're doing fundraising, and you just had, I think you just said you had an LP close with fund close, which is great news. How did you navigate sort of those stereotypes and like, oh, this is what's happening in venture? How do you navigate that when you're talking to LPs to really highlight the fact that the frothiness that may be occurring in later stage really has very limited impact on how the companies you see or the way you invest?
There's a few ways we go about that. I think number one is we talk about the idea that the companies that people are desperate for access to today were unknown pre-seed companies a decade ago in many cases, and were companies that would have taken money from anyone who had it on offer. And that will be the case a decade from now for the companies that we are funding today. That's number one. Number two, one of the biggest benefits of investing in private companies in general is the QSBS tax exclusion, which is only available for companies that have up to $75 million in gross balance sheet assets today. So if you are trying to get an allocation into Databricks or Stripe or Anthropic or any of those kind of companies, they're no longer QSBS issuers, and you will pay whatever long-term capital gains taxes you owe on those investments. Whereas an investment in a fund like ours, where we're investing in QSBS eligible companies, is going to be a 100% tax-free investment opportunity for people who live in states that whose tax code corresponds to the federal QSBS rules. So here in California, that's not the case. Any gains that a California LP has will be taxable, and you'll end up paying some money to Sacramento, but you won't pay any money to Washington, D.C. on the gains that we generate. That's a really attractive thing about our asset class that I think most folks don't spend enough time thinking about. The number one thing you can control as an investor in your asset allocation and on your investment choices is taxation. And if you can minimize your taxes, you can get an edge that is better than any investment edge that is available in the market.
I would add one other thing too, which is, maybe from the institutional perspective. So we have a lot of, institutional LPs already backing us, and then a lot that we talk to over time. And I think they also care a lot about diversification across, themes across the portfolio. So they're looking for, sectors of interest that we are preferentially exposed to, right? Alex mentioned some of what's going on in aerospace or robotics, those being core themes that we see a lot of here where we're based in LA and Southern California. They also are looking for just pure geographic diversification. So the fact that we are in a market that's not just the Bay Area or not just centralized in New York offers them a different kind of exposure across their portfolio. And then I would say definitely stage diversification. And so if you look at the average of sort of a US venture fund, most of them are this Series A structure roundabout, right? And so there are very few funds on a national basis who lead pre-seed rounds and have that level of high exposure to the company at that stage, who are doing this inception stage funding. And so I think that's something that our LPs are definitely interested in. And a lot of them actually are investors themselves, but at later stages. And so there's an opportunity for them to see companies matriculate out of our portfolio directly into, core investment opportunities for them. So those are also things that I think make the model enticing.
And the way you describe it, it makes it sound, and I think it's true, that there's a benefit to staying small, right? If you're raising billions of dollars, you're no longer investing in pre-seed businesses. So I don't want to talk about performance specifically, but I can see that Amplify has raised a marginally larger amount of money, which with each subsequent fund. So Connor, as you guys were thinking about this next fund and the right size, like what did you decide on? How did you go about making sure that you can continue to make the same investments you've been making while continuing to raise the fund size a little bit?
Yeah, I think one of the popular jokes that I use, right, is we've kept up with inflation over the years. And so that has definitely affected our industry over time. Even back to the founding of Amplify, looking back at 2010, 2011, right? We always sort of invested more than an incubator and accelerator. But in the early days, we were sort of compared to that stage because it was the closest analog to what we were doing, right? We might have been writing a $100,000 check when, a Y Combinator or Techstars was giving a company 10,000, and we were helping them raise that first $250,000, that first $500,000 into the business. And over time, it became apparent that the seed and Series A investors kept kind of migrating later stage, but then you had these, incubators and accelerators that stayed the same for all intents and purposes, right? And so over time, I think it was 2017, people started using the word pre-seed, right? And so there was finally a name for the stage that we'd operated at, but we felt like we were always that kind of interstitial period, right? Teams who wanted to raise that first bit of institutional capital, but maybe weren't quite ready for a equity seed or Series A funding, right? And I think a lot of, to your other part of the question, right, how we base the amount of capital that we're raising, it's partly on that, right, what we see in the market. And so if that round size is kind of continuing to increase on average, we want to be in that position where we can lead that round, price that round, and not just offer the company a minimal amount, right, and have to have them raise, the majority of the round outside of us. Like we want to be, kind of that larger voice and higher conviction investor in the room. But the other thing is really based on your return expectations, right? In order for our model to be successful, if we have a winner, quote unquote, right, in our portfolio, we want that to actually be a winner on a fund level, right? And so I think where a lot of investors maybe misstepped, and it caused a lot of LP angst over the past 5 to 10 years, is they kept raising these larger and larger funds, but the outcome bands didn't actually grow commensurately, right? And so the returns just kind of worsened. And so you had a lot of LPs LPs who are looking at these funds that had kind of grown disproportionately to the outcomes they were experiencing. And that's a tough spot to be in, right? And I think especially where we're at pre-seed, you have to bear a lot of dilution over the course of the company growing over time, right? And so we want to factor in, if a company of ours achieves, multi-billion-dollar valuation, that should be a phenomenal return for our LPs and for the fund. And I think that's something that, we prioritize when we're, setting the fund strategy.
Yeah, I think one thing that a lot of LPs in venture have observed over the last decade is that when managers lose discipline around price, it doesn't become apparent in returns for 5 or more years, because it takes that long for companies to grow at a level where you start to know how well a venture fund is doing. And 5+ years ago, there was a bubble in our industry when there was an infinite amount of free money during COVID, and valuations just were thrown out the window. And one thing that I think was admirable about Amplify when I was doing my due diligence on the firm prior to the merger was that Amplify stuck to its guns on the pricing and on the ownership expectations throughout that entire period. Stage Venture Partners did the same. We both, because we had the virtue of being lead investors, because we were price setters and setting terms on rounds, we weren't just in a position of accepting other people's sloppy underwriting. We stuck to our own underwriting discipline over time. We have funds that were raised in terrible vintages. The 2020 vintage is going to be a terrible venture vintage, unless one of those funds was in Anthropic or OpenAI at that time. So we both of our firms raised funds in terrible vintages, where those funds are doing great right now because we stuck to our guns and we had discipline at a time when other folks didn't. We are now in a time that has a lot of similarities to 2021, and where there are companies that are raising initial rounds of $500 million on a $5 billion pre-money valuation. And so you kind of have to be underwriting to, this is going to be a $1 trillion exit in order to generate venture scale returns for an inception round like that. Amplify can generate venture scale returns that would put us in, the very top of our vintage year with exit valuations in the single digit billions. And we have maintained that ability the entire time we've been in business. Companies that get acquired for $3 or $4 billion today barely get mentioned in the press. A decade from now, when we're exiting the companies that we're investing in now, maybe you'll see a tweet about an exit, and not much more than that. A few $1 billion isn't what it used to be.
And Alex, you mentioned something interesting there, that you don't really know whether, as an LP, you're not really sure what's going on for 5 years, and if they overpaid, or if the GP overpaid or stayed disciplined. So there's this, and I think it's true for your portfolio, Alex, because I think there's, in the Stage side, there's been some really successful investments in there, but not a lot have materialized in the way that maybe they will at some point soon. So when you're talking to an LP and it looks like it's been really quiet in a fund for 5 years or so, how do you get them comfortable with the fact that it's working as intended?
Yeah, there's a few things that are important there. Because companies are more efficient with their capital than they have been in the past, the time frame between major rounds is starting to extend. And so it's not unusual for a company I back right now to go 4+ years between a Series A and a B, or a B and a C. And when you're an LP in a fund and you see a valuation that has not changed for 4 years, it's a reasonable thing to ask, like, is that company still doing well? Like, are we going to make any money on that? And so I think GPs need to be talking about things like revenue growth, cash burn, pathways to cash flow break even, and things like that more now as interim measures. The hard thing is that you will occasionally get pressure from auditors or from investors to mark up the shares that you hold in a company to a price that no outside third party has ever paid for those shares. And I really don't like that idea. That makes me uncomfortable. And so I, as a policy, do not write up my own companies. I'll take my write downs when I need to, and we have never been shy about doing that at either Amplify or at Stage VP. But I think Amplify has two companies or maybe three where the 409A valuation on the common now exceeds the price per share at which we're holding the preferred on our books. And I think that tells you a little bit about, how long a company can grow without needing to access the capital markets anymore. I mean, I have a portfolio company that has not raised money since 2022, and where the revenue is 10 times what it was when that Series A was completed, and where they have used only half the money in 4 years. And they have half the money they raised in 2022 still on their balance sheet today in 2026. So, that's looking like a flagship investment in my fund. That's looking like the kind of thing that everybody's going to be saying, I told you so about it a few years from now. But that's what I know from the inside. From the outside, you would look at this and go, nothing's happened there in a long time. That company must, be on fumes. And that could not be farther from the truth.
One thing we've already talked about, the frothiness in the market that maybe you see in later stage venture, raises the kind of on the opposite end of that spectrum is what's happened to enterprise software companies, some of the public ones. And so it's, 2026, and a lot of these companies are living through the SaaS apocalypse. And I know you touched a little bit about that on this topic, Alex, on your podcast with Mev Faber. But I'm just curious, given, Alex, your historical focus on enterprise software, how your approach to investing in software companies is changing, if at all, given this, AI eats software theme.
Yeah, I think there's a few things to emphasize about that. I mean, number one, every software company we invest in today is an AI company from day one. That saying every company is based on every good venture company that we invest in should at all times be built on technology that was not available in the market even a couple of years ago. The best software companies at all times are creatures deeply embedded in time. They build products that could not be built a couple of years ago. They use tools that were not available even a couple of years ago as well. They are the kinds of companies that could not be built before. And if we get pitched a company and we think, this could have been built a few years ago, nothing has changed in tech, nothing has changed in customer expectations, nothing has changed in regulations, it's going to be really hard for us to build conviction around that particular company. So on the one hand, every software company we're looking at today is an AI company. They are building AI first products. On the other hand, do we think that the foundation labs and core AI providers are going to eat every single thing in software? And the answer to that is no. The answer to that is no for a bunch of reasons. Number one, markets that are big enough to return our entire fund many times over are 1/100th of the size that matter to a company that is now valued at $1 trillion. And so it's literally not worth the time of these big companies to go after the kinds of opportunities that are extremely valuable to us. Number two, every software company that was founded in the past, including most of our portfolio companies that are active today, are busy ripping their product and their company down to the studs at the moment and rebuilding everything they're doing around the new set of tools that are available to them. And so we are seeing accelerations in product development. We are seeing accelerations in product quality and in the size of the market that our companies are able to attack that none of us would have been able to anticipate a couple of years ago that are now becoming possible. If you look at what was happening in the public markets a couple of months ago when Paul and I spoke with Meb, I believe that conversation pretty much bottom ticked the SaaS apocalypse moment in the public markets. And you'll hear Paul and I talking in that conversation about how bullish we are on software and how we don't think that a lot of what was priced in 2 months ago was going to be indicative of where the world is going. And we talked about, in particular, infrastructure software as opposed to application layer software, software that touches money, anything in payments or in fintech, software that touches regulated industries, software that touches data that cannot ever be compromised, like healthcare. Anything where the stakes are really high, those companies are going to be just fine. So if you look where things are today, 2 months later, a lot of those stocks have re-rated. A lot of them are up more than 100% off of the lows that they were at a couple months ago. There are software companies that are continuing to have skepticism about their terminal value in the market. Point solutions and security continue to have questions around their viability, especially given what Anthropic is doing with Mythos right now. There's been a big diversion between point solution software companies and companies like Palo Alto or CrowdStrike that have more broad-based product lines in security. Anything that doesn't touch core enterprise systems, anything that's sort of nice to have, like collaboration software or website design software or stuff like that, those companies are continuing to struggle. So, there is the market 2 months ago was shooting first and asking questions later. It is now better pricing the distinctions between companies where AI is going to be a net benefit to them and companies that are going to struggle as a result of the technologies that are being released in the market right now.
Yeah. One thing I would add to the end of that, right? And Alex kind of touched on this with for an entire crop of companies, this is a net benefit. And I think that's one of the biggest narratives that the market reaction has kind of missed, right, over the past year. And so when we look at what is structurally one of the most difficult challenges that a software company faces, up until now, I think a big part of that has been you have to boil down what is usually a very complex set of requirements and everything that kind of constitutes a job or a workflow into a product that meets enough people where they are, right? And so if you look at like what these software companies were trying to do, oftentimes it was let's build towards the average user, right? And it's really hard to kind of encompass all of the complexity of a job or a role when you're doing that. And I think one of the fundamental things that AI enables is this level of dynamism, of personalization, where you can start to, meet the individual user, right, where, they are instead of vice versa. The user is not required to meet the product where the product is. You can actually deliver a differentiated experience. And so I think a lot of what we've been thinking about lately are like, where are these unique opportunities kind of arising, right? Where you can kind of have all of this complexity now housed under an ecosystem, and you can be, much more dynamic in the way that you serve those end users. And so I think for a lot of companies, this is actually a boon, right? They can, encompass a lot more of that complexity, and they can build in a fundamentally different way.
Yeah, around the office, Connor and I like to say these days that like your UX is not your product and your product is not your UX. And that has become much more true recently. About 6 weeks ago, I was at an event hosted by my portfolio company, First Resonance, that makes MES systems for complex manufacturing companies. And they hosted a customer demo day with Claude where they were showing off how their customers had built unique input and output workflows for their own particular needs using Claude that did read-write operations directly to First Resonance's Ion product, their system of record. So now the customers are building their own interface, their own workflows for Ion. It's a huge net benefit for First Resonance because it is deepening the engagement that the customers are having with the product, but First Resonance doesn't need to go and build for each of those use cases now. 2 weeks after we had that event at First Resonance, Mark Benioff at Salesforce announced that from here on out, Salesforce is going to be entirely headless. And so if Salesforce is going to be doing that, if the largest software SaaS company in the world is going full headless, we know that the future of software is going to be going in that direction.
One thing we have to touch on in this conversation is the founder side, because Alex, you touched on it. This is conviction investing. You're backing people. So Connor, I'd love to hear, because I'm not as familiar with how Amplify operated before Alex joined. I'm just curious, like, as you think about the value that Amplify can add to founders, what do you think is the most useful thing a pre-seed investor can do for a founder right after that check clears?
Yeah, it's a good question. I think, you know, a big part of the way to view a successful firm is one, you want to benefit from pattern recognition. And so I think having investors who've backed, companies across all different domains, that have worked with companies across different stages, you have this element of kind of seeing around corners, right? Where you can kind of anticipate some of the difficulties a company or a team is likely to face. And I think that's a lot of the value that we can provide at the early stage in terms of, the advice that we're giving teams or the people that we're able to connect them to. And on that latter point, on the subject of connections, I think, the best investors are these sort of connection super routers, right? In the best cases, we're able to introduce them to prospective hires. We're able to open, doors to customers. We're able to sort of, expand their network in order of magnitude in the early days. And so the rate at which a founder learns when they work with us is far and away faster than they would, on their own or with, either just angels or a firm that doesn't have that experience and that background. And so that's a lot of what we're trying to do, I think, when we back companies at that stage.
Yeah, I think one of the things that a pre-seed investor always has to be aware of is what is it going to take? What are the milestones that are going to be required for subsequent funding for a company? And because we spend a large amount of our time with downstream investors, we're always hearing about, what's the level of revenue required? How many customers are important? Do you need to have 10 logos or, 50 logos in order to raise your next round of capital? What are the net dollar retention benchmarks in the industry? What's the right interval of time between funding rounds? All of these questions are fluid. They change all the time. Things that used to be true are no longer true. And we always have to be giving advice that is current and relevant and actionable to our founders.
In going the other way a little bit, Alex, like, what do you think, for a lot of these people, they've never raised money before. This is maybe their first, first company that they're actually going out and raising money for. And what do you think that would be unrealistic for them to expect for a pre-seed investor to actually be able to deliver, as a partner?
It totally depends on who the investor is. What a multi-stage firm like Andreessen Horowitz that has, 500 plus people on their team can deliver versus what a boutique specialist like Amplify can deliver are two very different things. And so, we don't have 100 people. We don't even have any, one person dedicated to hiring. And so, there are firms that can bring substantial resources in headhunting to a company where they can help with putting in place a team. There are firms that have PR resources. There are firms that have all of those kind of things. You might be getting less partner time from those kind of firms. You might have, the sense that they are purchasing an option in your company as opposed to making a real bet on you, and where they're, really ride or die with you in the way that a boutique fund will be. So, there's always going to be trade-offs there. But, what's unrealistic for Andreessen to provide to a startup might be very realistic for us to provide, and vice versa. And so investors or founders should be very deliberate in terms of what they're choosing and what they're expecting as a result of that.
I would add maybe one other thing too, which I think a lot of times we talk to founders, they tend to overestimate the value of a firm and underestimate the value of an individual. And I think that plays a huge role into how we think about building our own firm, right? We need to be this collection of individuals at the end of the day who we think have the ability to sort of, be outperformers or outliers in helping the trajectory of that company over time, right? And I can't tell you the number of stories where we've had companies in our portfolio, they've raised from a firm, it's a great logo on the door, and they kind of have this expectancy that that is going to make the entire route from there much easier, right? And that most often does not pan out, right, as they expect it. But when they do have an individual, that board member, the person who's kind of leading the charge, who is in all of the calls, who's checking in with them, and that person is exceptional over a long period of time, that's when I think we really start to see, that delta in performance. So we constantly remind, our teams, right, our founders of that.
Yeah, and founders need to be very aware of the longevity of an investor's position within a company or within a firm, because the average careers in venture are short. The average career for somebody starting a venture fund doesn't get past Roman numeral two very often. And the average career for somebody in an associate or junior partner investing role at a large established firm is probably about 4 years, because most people last that long because they do a handful of investments and none of them produce any kind of returns. And a non-managing partner person on a deal team who is not producing returns is a cost center. And so as a result of that, it's pretty common for people to get investment from somebody at a pretty high profile firm, and then 2 years later that person is no longer at that firm and they have an empty chair in their boardroom. And that is about the most dangerous condition I can imagine for a founder, short of not being able to make payroll next week. Having a board seat at your company that is unfilled, having a lack of sponsorship from a majority owner or a large minority owner in your company is incredibly dangerous for a company that has raised money and that expects to raise money in the future. And I have often counseled my founders, when they have been in that situation, to get on a plane and show up unannounced at the office door of the firm and demand a meeting with the managing partner and demand that that managing partner take a board seat at their company to replace the person who has departed. Because absent that, I don't see them being a priority for that firm when the sponsoring GP has left.
Before we wind down, if you've ever listened to this podcast, you know I love to talk about investment mistakes. So I'd love to hear from both of you about an venture investment mistake. Not and Alex, public. We've both made plenty of public investment mistakes. We'll save that for another day. But a venture investment mistake that was, maybe that's a people choice or a business you backed or
I'll
thesis that was wrong.
I'll start
that
with that.
that changed the way you invest forever.
I have a somewhat controversial opinion about investment mistakes in venture. I believe that it's dangerous to learn lessons from mistakes of commission in venture capital. And I believe that because when we invest, all we can lose is what we put in. But when we win in our industry, we have a pretty good shot of making 100 times our investment or more. And certainly when we have funds that perform well, it's because we found something of that scale. And if that's the kind of skew of outcomes that exist in our asset class, it is much more dangerous to make mistakes of omission rather than mistakes of commission. And the logical implication of that is that we should simply forget mistakes where we lost money. We should have a mind like a goldfish and be prepared to meet every new company for what they are, to try not to pattern match too much to things that we've lost money on. And I actually think we should spend most of our time learning from our successful investments that we have made, but more importantly, the chances that we had to invest in companies that later went on to great success, but that we, for some reason, did not participate in. Maybe because we decided not to do it. Maybe it's because we dilly-dallied and didn't win the chance to contend for that round because of speed. Maybe it was a different reason. But I mean, if I think about the worst mistakes I've made in my career, I mean, there's a very high quality company here in town in LA that does workflow software for salons and barbershops and stuff like that. And I had every opportunity to participate in their seed round back in 2017. I overthought it, and I didn't like the relatively small annual contract values. I missed the ability to embed a payments platform onto the product over time to drive the annual contract value higher. And I talked my way out of an investment that probably would have returned about 100 times the capital that I had every opportunity to put into that company. Closer to home, Paul and Connor showed me Safe Ride Health, I believe around 2018. And Safe Ride is an Amplify portfolio company that helps match patients that need high frequency healthcare, like dialysis treatments or things like that, that lack access to reliable transportation to get to their doctor's appointments. And I didn't know much about this market. I spent some time trying to learn it, but I never got the real insight about the value of the need and what it does to unlock better clinical care for the patients and greater revenue for the providers. I did not think of it as a revenue generator in the way that it actually was, and I missed that opportunity. That's a flagship investment in Amplify. That could have been a flagship investment in Stage Venture Partners back in 2018, and I was too clever by half.
Connor, given Alex's perspective, any errors of omission that you want to highlight?
Probably too many. Yeah, I think in a very similar vein, there's kind of two things that I think a lot about here. One is maybe an encapsulation of some of what Alex mentioned, which is venture is a what can go right business, not a what can go wrong business. And I think, bearing that in the front of your mind when you're evaluating a company is something that, is kind of like ingrained now. Because I think it's difficult. Sometimes you have conviction on an underlying technology, but we're really bad at thinking about exponentials, right? We're really bad at kind of forecasting if the next couple steps in the chain go right, what could actually kind of materialize for this business over 2 years, 5 years, 10 years. And the other thing, and this comes from, in the past when we've hired people, when we've brought on interns, when we're training people in this business, like we are all students of this. And I think everyone on our team loves reading memos where they're available. And a lot of firms will publish their memos of the investments that went well, the ones that went poorly. And it's this great retrospective where you can see what were they actually thinking about the company at the time they made the investment. And so a lot of times, like we'll have, people that we're bringing onto the team just read as many as you can find that are available. And one of the things you notice almost across the board as like a universal phenomenon is they underestimate the market potential, right? I remember Bessemer, I think, writing a memo about Shopify and kind of, thinking about the entire market opportunity if they did everything right as maybe single digit billions, right? And this is a company that is, probably currently trading at over $100 billion market cap. And so you notice that they're off by orders of magnitude. And it's sort of like you need to internalize that when you're looking at a company. And so Alex and I were talking about one recently, and without naming names, I think, it was a company that we had passed on. And it had to do with computer vision, right? And this was probably about 4 years ago. So it's pre, the latest and greatest techniques, the current models that are being released by the foundation model companies, this kind of, past couple years of the exponential and AI. And the amount that you're able to do now with computer vision as opposed to what you could do even 4 or 5 years ago, markedly different. And so I think of a lot of the reasons we passed on that company, we're just thinking like, oh, they're going to need to augment with all of this additional manual work. It's going to be impossible to process this volume of data. And so we were very bullish, I think, on the underlying application and the ability for them to go to market, but we completely underestimated how much better like the core technology would become over that, intervening 5 years. And so I think a lot about that. And so when we're looking at things today, you have to think, okay, if we have conviction on the team, if we have conviction on the technology, what is that what could go right case of what this looks like in the next 5 years, how much that tech progresses as they're building with this tool. And so that's, I think, top of mind for me.
Yeah, I mean,
go ahead.
It's that lesson in venture, I think, is very applicable for a podcast called Compounders. And if you think about what powers compounding in our industry, is the inexorable march of the scaling laws that have defined technology over the last 50 to 100 years. Moore's law continues after, 55 years since it was first published. In AI, we have all, I think, internalized the bitter lesson, as it was described in a blog post in 2019, that you throw more compute at AI and the AI just gets better. And as students of the market, we have to really take an intellectual leap, take a leap of faith that we at the moment we're making an investment are not at the end of a cost curve that has gone out on for decades now, that cost curve is going to continue, that increase in capabilities is going to continue. And we have to have the imagination for what will that cost curve look like in 5 years? If you go back, talking about like how Connor was saying that people who underwrote the Series A in Shopify couldn't imagine what Shopify became. I'm sure that was the case for the folks who did CrowdStrike or the folks who did Cloudflare or some of the great software companies of the last 10 or 15 years. But you see it everywhere. You go back and you read what people were saying about the growth of solar energy a decade ago, and every single forecast was wrong. And every single forecast was wrong on the downside conservative side of the ledger. Everybody underestimated how fast something like this could scale. And I think betting against exponentials is the easiest mistake to make in venture capital.
Well, guys, this has been amazing, and I'm just so honored that you guys would be on for the 100th episode. We'll close with a question we ask all of our investor guests, and maybe Alex, I'll give you the floor to close it out. What do you think is the most underappreciated aspect of the investment opportunity in front of Amplify today?
The upper bound keeps changing in ways that make the asset class more attractive than it has ever been before. And, we are 2 weeks away from having a venture-backed company that's 5 miles away from where I'm sitting right now, SpaceX, go public for $1 trillion or maybe even $2 trillion. I've never conceived of that before, of a company going public at that value. We're going to have more than one this year. Is it possible that an IPO a decade from now might happen at a 5 trillion valuation or a 10 trillion valuation? I mean, could that happen? I mean, when we make an investment, we can return our fund multiple times over with a single-digit billion-dollar exit. Now that we know that the upper bound for the valuation of public companies is in the trillions of dollars, there's I think $20 trillion companies that are publicly traded around the world as of right now, maybe 30. Several have been added to the club this week. That means that companies that return our entire fund multiple times over could go public and then become 1,000 baggers on the public markets. And so the scale of the capital markets are nearly fractal. Returns are possible at every level of the fractal curve. And it's pretty amazing that we're living in a world like that. There was a book that came out about 7 or 8 years ago called The Beginning of Infinity. And what we see happening in the capital markets today really convinces me that we are living at the beginning of infinity. And it's a fun thing to be a part of.
Well, what a wonderful place to end that. Alex and Connor, congratulations on the recent merger. It sounds like there's a lot of thought that went into it, some serendipity and a lot of thought, and wish you a lot of luck as you are navigating something, a very interesting investing environment, but obviously with some incredible outcomes potentially there as well. So much thanks for being on Compounders.
Thank you so much for having us, Ben, and congrats on 100 episodes. Really excited to be a part of this one.
Congrats, Ben. 100 is a great milestone, and we are delighted to be a part of it with you.
Thanks, guys.